Good morning and welcome to the Senior Hour, which is sponsored by Santa Clarita In-Home Care and Advanced Audiology. I'm Barbara Cochran with my co-host,
Dr. Gene Dorio,
on your hometown station AM 1220 KHTS. This is a show for, about, and by seniors, giving information to enhance one's quality of life. And our guest this morning is Richard Sherman of Reality One Solutions?
Realty. Reality.
Realty.
Reality we sell on the third floor. Realty we do downstairs.
Oh, okay. Realty.
Realty.
One Solutions. Welcome, sir. How are you this morning?
Thank you. I'm very well. Thank you guys for having me.
Good. And what are we going to talk about today?
Whatever you'd like. Being the Senior Hour, I'm assuming we're going to want to talk about reverse mortgages and maybe Prop 13 and maybe some of the assisted living facilities in town, that sort of stuff. But we can talk about whatever you'd like. I'm been doing this for a very long time, so nobody knows everything, but I know an awful lot. So whatever you'd like, ask away.
How about reality?
Yes, reality. Yeah, that I know less about.
Don't we all?
Yes, don't we all? Well, let's talk about some of the problems that some of our seniors might be having who are on fixed incomes and struggle with making a house payment.
Well, that's actually one of my favorite topics, as a matter of fact. Over the last dozen years or so, my staff and I have gotten very heavily involved with doing loan modification work, preventing foreclosures, getting people's mortgages lowered by getting their interest rates lowered. Mm-hmm. And a loan modification, unlike a refinance, takes the loan you already have and gets those terms changed, whereas a refinance would be getting an entirely new loan. And with a lot of our senior clients, what we find is when they're on a fixed income, when they're on Social Security or on a retirement, which is usually a lot less than they had when they bought the house, mm-hmm. It becomes very, very difficult, not impossible, but it becomes very difficult to refinance because they just don't have the income.
And they have to qualify, don't they?
And you have to qualify. That's yes. Exactly right. Which makes a loan modification a much more attractive option, because you're taking the loan that's already there and approaching the lender and saying, that 6.5% didn't seem so unattractive a couple of years ago, but it needs to be lower now, otherwise we're going to wind up with no place to live. And there are a number of things. Reduction in income is one of the primary, but there are a number of things you need to do to qualify for a loan modification. But to be quite honest with you, it's a very difficult process. My father likes to say that changing the transmission in a 57 Chevy is difficult. And if you've done it 1,000 times before, it's quite easy.
Very hard, very easy to do.
Like any task, if you do it all day, every day long enough, it gets easier. And we've been doing them for a very long time, and our success rates are extremely high, particularly with people who are on fixed incomes, because they often think, I'm not behind on my payments. I don't make as much money as I once did because I'm now retired or I'm now on Social Security or a combination. I have no options, and that's just not true. There is no requirement. It is easier to get a loan mod if you're behind, but you don't have to be. We try not to have people intentionally ruin their credit just to get their interest rate lower if we can avoid it. But we've been very, very successful at going back to the banks and saying, our client used to make this, now they make less than that as a result of their retirement, and we need to talk about getting that interest rate dropped so they can afford to stay in their house. Otherwise, the bank's going to have yet another foreclosure, which they don't want.
But wouldn't, in the beginning, let's say you get a 30-year loan and, you're 45 years old, you would think that somebody, your financial advisor, would say to you, hey, you're going to be 75 years old when this is paid off. Your income's going to go down if you retire at the age of 65. Wouldn't somebody say there's going to be a 10-year problem in terms of you trying to pay this off?
It's a fabulous theory, but unfortunately, the people who would be giving that advice, most people don't have financial advisors in most cases, in my experience. So they're relying on the lender, and it has also been my experience that particularly in that end of the industry, whatever makes money will happen. And if it is profitable for the lender to give you a 30-year or a 40-year mortgage that they know darn well you're not going to be able to pay 10 years from now or 20 years from now, or whatever the story is, their attitude is going to be that's not their problem.
Yeah, so that's the purpose of the show, to advise people who are 45, 55 years old. You're buying a home, and people are doing that. They're out there. The interest rates are pretty good up till last week. So we're doing.
Oh, they're still pretty good.
Things are, they're still looking really good compared to 20 years ago. But I think it's important that people understand what they're getting into before they do it, and then anticipate their need. Just like in medicine, I have to practice preventive medicine and make sure that they're looking at their cholesterol, they're looking at their blood pressure. Well, they have to also look ahead and say, okay, I could have 10 years of payments that I can't afford when I've retired.
Well, unfortunately for the public at large, and I don't want to pick on the entire industry because the entire industry isn't corrupt, I suppose, just large swaths of it. When it comes to mortgages, there is no one who is an advocate for the client. There really isn't. It's very much buyer beware, which is extraordinarily unfortunate, which is one of the reasons I was so happy to be asked to come on your show.
Yeah, I've heard of buyer beware.
Well,
in a lot of areas, but I've also heard it in the real estate market also.
I usually hear it as an excuse when somebody's done something awful to a client of mine. Well, it wasn't our problem. Buyer beware. And you're talking about an entire industry. I'll give you one of my favorite examples, sort of to express myself here. When you go to get a mortgage loan, regardless of your age or your situation, the lender is going to say something along the lines of, this loan is going to cost you 1 point, 2 points, 3 points. Mm-hmm. And I don't know what it is about people in this part of the world, but everyone sort of just goes, okay. They have no idea what they're talking about. What is a point? What is 2 points? If you don't know what one is, what is two? And a point is just a way to describe an amount of money. 1 point is 1% of the loan amount. 2 points would be 2%. Now, why doesn't the lending industry simply say, if you're getting a $200,000 mortgage, this is going to cost you 1 point, which would be $2,000. Why don't they just say it's going to cost you $2,000 to get your loan instead of saying 1 point? And I have the answer to that question, which is sort of the old Bugs Bunny cartoon, if you can't convince them, confuse them, where Bugs Bunny and Daffy Duck are saying duck season, rabbit season, duck season, rabbit season, and Norm says the same thing twice, and they go, oh, I got you. That seems to be the way the entire mortgage industry works as far as communicating with the client. Now, it's gotten better in recent years, thank goodness, but it's still awful. There is an entire vocabulary that is intentionally kept complicated to make it harder for the public to understand. Now, if I were to tell you this is going to cost you $2,000, you would know what I was talking about. And your response would be, why am I paying $2,000 for this? Mm-hmm. Or whatever that number is. But if I say to you, this is only going to cost you 1 point, people go, one sounds less than two, that sounds okay. Mm-hmm. Or worse yet, this is only going to cost you 4 points, which would be an outrageous amount of money. People will go, well, 4, that sounds fairly low. I like 4. 4 is good. Because it's weird. I'm not from here, maybe that's why I didn't grow up in the United States primarily, but it's kind of odd that people are just terrified of saying, what does this mean? Explain this to me. And even the people who do often get a lender, there are good lenders and bad lenders, as in every field of expertise, but with a bad lender, they're going to tap dance around it because that is where they make their money. That is where they make their fees. So they're not going to be in a big hurry to explain to you the whys and the wherefores. They're going to be in a big hurry to get your signature on the document and move you along.
That's right. Mm-hmm.
Well, I'll put it this way. How many of your listeners do you suppose even remember who did their mortgage if they've been in that house for more than a year, let alone 5 or 10 or 20 years? It's pretty rare. I get people all the time. I was talking to a guy yesterday, as a matter of fact, who said, I've talked to a lender. My lender's great. My lender's wife is great. Who is it? And he paused and he said, I don't know. I said, you got a loan 6 months ago? You don't remember who it was? Boy, they made quite an impression. And their follow-up has been spectacular, clearly. Because the attitude with that industry is once you're out the door, you're out the door. Money made, move on. It is not held to the same standard. Your mortgage lender is certainly not going to be held to the same standard as your physician, and perhaps they should. But because you can do as much financial damage as if destroying somebody's life financially doesn't have an effect on them, just like destroying their lives medically would as well if you were irresponsible.
But medicine is so complex. Not so much what I do in terms of diagnosing and treating, but the whole system itself, like the insurance part of it, Medicare part of it.
Sure.
Is it not just if you can't convince them, make it more complex, and that's what they've done?
Yes,
yeah,
I
if you
agree.
can't convince them, confuse them.
Where's that quote from? Daffy Duck, you said?
Well, I have a 9-year-old daughter, and it's her favorite cartoon. It's Bugs Bunny and Daffy Duck. It's a classic. I think it goes back to the 40s. It's called the name of the cartoon is If You Can't Convince Them, Confuse Them. And my wife pointed out to me some years ago when we were watching that for the umpteenth time with our daughter, that my wife turned to me and said, it's not entirely unlike the mortgage industry.
And the insurance industry across the board.
And a lot of things, yeah.
That's what our seniors face these days.
Mm-hmm, mm-hmm. It's real, and honestly, it's not that complicated. Real estate in general is not that complicated. Mortgages are not that complicated. But nobody involved has any interest in trying to make it simple for the public. What they want to do is make it as complicated as they possibly can to justify their own position and thus their own fees. Yeah. And we really try very hard to undo that. And we're very lucky in our community in that there are some excellent lenders out there who, I don't know, I didn't used to call it a belief structure, but it really has become that, who believe similarly to I do, that if you educate your clients and you make this stuff easier to understand rather than more difficult to understand, aside from being the ethical and moral thing to do, it's also better business. You'll get more clients as a result.
That's correct.
Mm-hmm. It's just a better way to behave.
I think you made 2 points on that.
Yeah, that's word of mouth. Mm-hmm. And that is powerful. It really is.
What's that great expression? The only type of advertising that's really worth a darn is the only type you can't buy, and that's word of mouth. So
right.
we live, as a realtor, I live and die with my clients' opinions. Most of them are very fond of me, not all of them, unfortunately. Can't please everybody all the time over 24 years, I guess. But luckily, the vast majority are very pleased with what we do because we do as much of it as we do, and we try to, we're very client-centric. And it's my case, I'm very selfish. I want my clients to come back. And if no one else wants to explain to them how things work, and I do, then I've got a pretty good shot at having them come back. And I want them to come back not just when they're buying or selling houses. I want them to come back when they have a question. I want them coming back whenever they have anything going on that has anything to do with real estate. I want them to view me as a resource. That's, again, why I like shows like yours and then the others I've been lucky enough to be involved with.
Well, now, how do you go about getting a loan modification? What are the steps that someone would take?
There's quite a lot to it. Again, unnecessarily complicated. The first thing to do is give me a call. I'll give you a phone number to your listeners. It's 661-714-1400. Let me do that again. 661-714-1400. That's actually my cell phone number. I'm available at that number 24 hours a day, 7 days a week, because I like what I do a lot, so I'm happy to do it. And as far as loan modifications are concerned, what I ask clients to do is bring me in copies of their last 2 months' mortgage statements and any correspondence they've had with the bank, and then just come into the office and we're going to sit down and kind of go over their situation. Every situation is going to be different. Every situation is going to be unique. Really what we're looking for are a couple of key things. What has changed between when you got the mortgage and now? What's your reason for economic hardship?
Well, maybe it's because we've retired.
Retired often. Yeah, often that's the case. Often,
and
absolutely.
we're on a fixed income.
Absolutely. The next question would be, what is that income? Do we have enough income there to sustain a mortgage payment at all? And in most cases, the answer is yes. Then it's a matter of sitting down and talking about who the bank is, what we can expect out of that bank, what the track record has been with that bank. And we've dealt with everybody. I haven't actually counted them up, but I think we're well over 1,000 now of these that we've actually completed, and certainly a lot more than that we've been involved with over the years. And they kind of put together basically a battle plan. How are we going to do this? What are we going to do? How are we going to attract? How are we going to show the income? How are we going to show the hardship, whatever that may be? And what do we think our targets are? What do we think we can do? I mean, if your interest rate, as a matter of fact, I've got somebody I'm working with now, that's exactly their situation. They're retiring in April of next year, and the bank has turned them down twice, once without me and then once last week with me, where they've said there's no imminent default. Well, their income is...
what does that mean?
That means as far as the bank is concerned, they are not in any danger of not being able to make their mortgage payment. Which is ridiculous.
Imminent default.
Yes, imminent, not imminent.
Imminent.
With an I, imminent default. Default is coming in the future. They feel there's no default coming, which is ridiculous. These people are about to have their income cut by more than 50% because, and he's not retiring as a matter of choice. His particular field of expertise, he has no choice. When he turns 65, he retires. His job cannot be done by somebody over 65.
Oh, that's ridiculous.
It is ridiculous,
Well,
especially given his qualifications.
flying an airplane.
That's
commercial aircraft.
Well,
yeah, I didn't want to point out. Yeah, that's exactly what it is, commercial pilot. But
then I can understand that.
But you can't use them to train other pilots? You're telling me you can't?
Well,
somebody who has 30, 40, 50 years of experience flying airplanes, you're telling me an airline doesn't have something else they can do with them?
Oh, I agree.
That's crazy.
Well, I know that one of the airlines, and I'll mention it, United Airlines, will take their pilots at 65 and put them in as trainers. Mm-hmm. So they do that because that's what happened with one of my patients.
Yeah. There are only so many trainers available, unfortunately, is what you know.
Yeah, but he got his spot.
Yeah.
And he did it till he was 70.
But with this particular client, he can't fly anymore, so that's that. And so his income is going to drop dramatically. And the bank involved, who are really not supposed to mention, but they go by the initials Bank of America, have decided that despite the fact that he has no choice, and his birthday is when his birthday is, and he is going to be forced to retire, he has no choice in the matter, that they've just decided it doesn't count. And that's ridiculous. What they want him to do is intentionally miss payments. This is the advice we got from Bank of America. You should intentionally miss payments, screw up your credit report, and then we may deign to give you a loan modification.
Then you change your category instead of not in imminent default.
Now you're in default.
Right.
But they should intentionally mess up their credit just so they can get a loan modification.
Isn't that
ridiculous.
something?
That would be like...
Just think if we applied it to health.
Well, I was going to say, that would be like that would be like you as a doctor saying, well, I'd like to do preventative care for you, but really maybe you should cut off a finger or something first, and then I'll be happy to
drink all the eggnog you want over the holiday.
Then we'll talk about your cholesterol. Yeah, it's just ridiculous. But there's a very it's not my problem attitude when it comes to the banks. And that just permeates. And especially when it's you're dealing with somebody who's current and somebody whose only reason for default is because they had the bad taste to get older, which is insane. I mean, it is. But so much of what we deal with in the world of loan modifications is insane. And I tell clients all the time, there's a certain element, a client once put it to me this way that I thought was the best explanation. It's sort of like Alice in Wonderland, in that, and it's probably been a long time since anyone out there has read Alice in Wonderland, unless you're a high school English class. Alice's life in the first few pages makes perfect sense. Very normal schoolgirl. Then she goes through the Looking Glass and everything goes crazy and all the stuff, all of Mad Hatter and all the characters we love. People who live in Wonderland don't think it's strange to see talking cats. People who live in Wonderland don't think that talking playing cards is odd. It's everyone else who thinks it's strange, and that's what makes it the story. That's very much the way loan modifications work. I don't think it's odd when a bank says, well, we realize you're retiring and you're guaranteed that your income is going to go down, and that these are things that are already forecast, but let's wait until you can't make the payment for a while, and then maybe we'll deal with the problem.
Now
that sounds normal to me. That's average.
But that doesn't make any sense at all.
Right, but it's not the common sense part.
Yeah.
It's not the common sense part of
So
life.
let's talk about how we fix that, rather than dealing with why the banks are as ridiculous as they are, because we'll be here all day talking about that. So what you fix that is you go back to the bank and you remind them that there are certain guidelines and certain rules that despite their behavior, they must live within. They often don't even know them. The people at the banks often don't even know that these laws and these rules exist. Now, if you were at a bank, at any of the banks, and you were working in their asset loss division, and your job was to work on loan modifications, it might be handy if you knew how one worked. It might be handy if you knew what the government guidelines were for them. It might be handy if you knew what the Homeowner Bill of Rights is, which is a law that we have in California that's very, very handy in this regard. It has to do with how banks are allowed to foreclose. It might be handy if you knew when a bank behaved or misbehaved, rather, who to report them to. Because there really is very little oversight. We have some now. We didn't have any for many years. We have some now. But we find what happens in most cases is if you go to the bank and you say, this is the situation, and by the way, with somebody who's going to have a reduction in income, a pending reduction in income, they're going to fall into one of three categories. Is that reduction happening within the next 12 months, the next 6 months, or the next 3 months? And depending on the type of loan you have and the bank that you have, if you fall into one of those three categories, you can usually use the fact that there is an impending change in your circumstance, even though it hasn't happened yet. You can usually use that to force the bank to open a file. And then once the file is open, you can sort of move it up through the bank and go yell and kick and scream through the various channels of the bank to get these things fixed. But this particular client, the way his particular loan works out, without getting too far into the details, which I think would bore a lot of your listeners, in his case, if he's within 3 months of a loss in income, they have no choice. They don't have to grant a loan mod, but they must consider a loan modification. So it's April, so we're just going to resubmit in January. And we'll get it fixed. We get these things done all the time. So we'll get it fixed for him. We just do.
But it's complicated, Barbara.
Yeah. Thank goodness.
Unnecessarily complicated. But going back to the rules and regulations you were talking, guidelines you were talking about, it stems from federal, state laws that govern these institutes, and they have to be followed. And as people who take loans out, there are a Bill of Rights.
Yeah, they absolutely are.
They have, and we have these rights, innate rights, that are guaranteed by these laws. But if you don't know these laws, you're done. So you have to investigate that. Where would, like on the internet, where would we go, Richard, to find?
The bank certainly isn't going to tell you. That's for sure.
Right. So that's why you're going to tell us, because you're the one solution for us.
Google is your best resource for these sorts of things. Google, Yahoo, whatever your search is. And I'll give you a couple of terms you can search. Start with Home Affordable Modification Program, HAMP, HAMP.
HAM.
Should also try Homeowner Bill of Rights or California Homeowner Bill of Rights. And honestly, beyond both of those things, just give me a call. It's just going to be a whole lot easier if you just call me. I can walk you through it, because most people aren't really that excited about getting into their computers and spending hours reading up on the California Homeowner Bill of Rights or talking to the Attorney General's office about
But they shouldn't they?
Yeah, but people also shouldn't drink too much eggnog or eat too much candy, eat too many candy canes over the holidays, and they're going to. That's just the nature of humanity, for good or for ill.
Very interesting information.
I hope so.
Loan modification.
But we're going to take a break, aren't we?
Yes, we are. I'm Barbara Cochran with my co-host, Dr. Jean Dorio, on your hometown station, AM 1220 KHTS.